Hello, everybody, and welcome back to episode 3 of Gen Z Talks Money. My name is Samuel Kimboyer II, a 15-year-old high school student and your favorite financial coach. So, we are back here on Gen Z Talks Money to discuss Alpha Part 2, which is my sequel to the video I did a few weeks ago. And it has certainly been some time. I know we have all been busy with school wrapping up. I most definitely have been. So I think we definitely need a little recap on what alpha even is. So remember, alpha is that term used in investing to describe an investment strategy's ability to beat the market. So say your portfolio, right, your assets under management, whatever money you're managing, say it generates a 15% annual return. So all the stocks you bought, you return 15%. And let's say the S&P 500, which is a benchmark index, returns 13%. That means you generated 2% alpha, you beat the market by 2%. It's very basic. That's what alpha is in investing. And if you remember, the last video, we covered fundamentals. We covered something called fundamental analysis. And basically what we talked about is that fundamental analysis is an analysis of the financial and economic factors that influence a business. That's the first definition of fundamental analysis, or the first goal of fundamental analysis. And the second goal is an attempt to determine fair value. Because remember, a stock is only worth what you are willing to pay for it. And we addressed the income statement, the statement of stockholders' equity, the balance sheet, the cash flow statement, all of those financial statements and what they contain and how you can derive information from them. And then we talked about some metrics to add another layer, another lens to your understanding of the financial statements in the 10 Qs and the 10K of companies. So we covered earnings per share, price to earnings, return on equity, debt to equity, and net profit margin. And if you need any reminders on the meanings and the applications of those metrics, you can always go back to the last video. I'll leave a link in the description. Now, if you remember back to the last video, I actually mentioned two different types of analysis that are important in achieving alpha. The first one was fundamental analysis, which of course I covered in Alpha Part 1. And in Alpha Part 2, I'm going to cover technical analysis. And the basic definition of technical analysis is an investing discipline that attempts to predict stock movements based on analysis of past market data. So, what is that past market data? Mostly that past market data is going to be things like volume. It could be things like volatility, but most importantly, it's going to be price action, the price of the stock, where that price was a week ago, where that price was a month ago, where that price was yesterday. And this price is represented by charts or price action charts. And price action charts are the center of technical analysis. Technical analysis revolves around charts completely. And what charts do, put very simply, is show price action by giving a visual to past stock behavior. So as you can see right here to my right, we have a chart of the NYSE, the New York Stock Exchange Composite Index, and the price action chart consists of two things. On your x-axis, you're going to have time, right? 2000, 2001, 2002, and so on, all the way up to 2019 in this case. And then on your y-axis, you're going to have price, the price of the stock or the price of the index in this example. And we also can look at our time frame because all charts have time frames. In this one, it happens to be the daily time frame, which means that all these little symbols called candles, which we are going to talk about very soon, represent the price action, the action of the price, right? That asset's fluctuations each day. So each of these represents one day. So as you can see, all these days you have an uptrend. These days you have a downtrend. These days you have an uptrend again. That's what price action charts show. And time frames can go all the way up to a year, or they can go all the way down to 5 minutes. In fact, some platforms like the one I use even offers 1 second. So you got to have your time frame, you have your price on the Y, and you have your time on your X. Very simple. So now that we have defined technical analysis as an investing discipline based on past market data, and also now that we understand what charts are, we can start to further our understanding of technical analysis and begin to learn some of the applications it has to us in finding stock plays that can generate alpha for our portfolio. And while technical analysis is an absolutely massive topic that is going to come up many times on this channel in the future, the three things I want to discuss in this video to give you guys a foundation is going to be candlesticks, charting, market structure, and indicators that you can add onto your charts. Very useful indicators that are going to give you a good grasp of where price is going if you interpret them correctly. So for all of the technical analysis that we are going to do in this video, we are going to be using the TradingView platform, which is basically just a charting software that gives you access to market data for any stock you can possibly think of. And it is completely free. All you need to do is go to tradingview.com and make an account, which is completely free, and you will be able to access all of their tools. And this truly is the best charting software in my opinion. And I have used paid ones. I've used the Yahoo Finance paid one. I have used charting platforms through brokerages like Vanguard and TD Ameritrade, Charles Schwab. I've used all of those. This is the best one. I always come back to this one, tradingview.com. Now, to get into the actual content of this video surrounding technical analysis, the first thing I'm going to touch on is chart type. So when you are going to create your free account on TradingView and open up a chart, there are going to be several ways to display that price action data. The first way, the one I personally started on, is called the line graph, which is very simple. Basically, all that the line graph is showing you is close to close on the day or whatever time frame you're using. So as you can see up here, I have my time frames. So 15 minutes, 30 minutes, an hour, 4 hours, a day, a week, a month. You can go higher and lower. So you can go lower than 15 and you can go higher than just a month. But all the line does is show you close to close from that period, from one period to the next period. So in this case, we have days. So all of the period for all of these lines is 1 day. So as you can see right here, down here, you can see that you have Thursday the 2nd, May 24th. This is where the stock closed. It looks like you closed at 465.36. The next day, Friday the 3rd, May 24th, you rose 470.13. So all the line graph is showing you is close to close. Where did the stock close on Thursday? Where did the stock close on Friday? The line graph then connects those two closes and indicates the direction, which is up. So the line graph is definitely the easiest graph to understand because it just shows you the fluctuations of the asset, of the commodity, in our case of the stock, right? It shows you all the ups and downs. But when I started off, maybe a month after I started, I began to realize that the lines were limiting me because there were ways to get the same information that the line was giving me and more. And that way is going to be through candlesticks. So let's do some candlestick analysis here. I can explain it. Basically, a line only has two parts, really. Close to close. A candlestick has four. First, you have your open and your close. And this is green means bullish, red means bearish, bullish means up, bearish means down. So, in this case, we'll use the green for an example. We'll use the bullish candle, the up candle for an example. You opened at 9:30, which is when the stock market opens. At this level, you rose throughout the day and you closed right here. That is the body of, it's called the body of the candle. But candles also have what are called wicks or shadows. either or, shadow, a wick, it's the same thing. And what these show are the lowest and the highest point the price reached during that period. So let's assume this is a day candle. Let's say each candle on this chart represents a day. You open down here, but say before you go higher, you went down a little bit and you reach this point and then you come back up. Well, see, for a line, you would have no idea that price was ever down here because there's only one part to it. But with a candle, you know that the price came down, which gives you a lot more information and a lot more insight. And then it came up throughout the day, but it actually went higher than it closed at, right? As you can see, we have the marked high, and then it came down. So candlesticks, first of all, everything related to technical analysis, like any other YouTube video you're going to watch, they're going to be using candles. Everybody uses candles. I use other things like Renko and Heikin Ashi, but candles are the most important, and they're what you need to know. And we'll come back to this later in the video, but just so you understand it before we get into the charts. So now that we know about chart type and we have selected candles as our main chart type, we are going to start charting market structure, which is the second goal of this video. And we're going to be charting this market structure on the VOO, which is the Vanguard ETF exchange traded fund, which we talked about in the first video for the S&P 500 index. So the first thing I want to talk about when it comes to charting market structure is that charts do not just behave arbitrarily. It's not just random. It's not just the stock is here, whatever. It's not, that's not how stocks behave. There are universal price action patterns. There are universal price action behaviors that we can identify and that we can use to make money. To break it down into two, as simple as possible, on the most basic level as possible, it's going to be expansion and contraction. Every single stock chart has periods of expansion, and every single stock chart has periods of contraction. More specifically, there are two types of expansion. The first is mark up, the second is mark down, and there are two types of contraction: distribution and accumulation. So when you are looking at a chart, when you are looking at a price action chart for a stock, you're going to look for those four things. You have to identify whether you're in mark up, mark down, distribution, or accumulation, and trade accordingly, which is what we're going to talk about for the rest of this video. And for a visual of these four phases of the market according to the Wyckoff market structure, you're going to have accumulation, which is contraction, where price is moving sideways, where it's becoming more stagnant. You're in a defined range where eventually you break out into markup. Then you enter distribution, which is the same thing as accumulation. It's just off of an uptrend versus a downtrend. And then finally you have mark down. Now, these patterns are not always going to display themselves in such an ideal, perfect world way where after a downtrend, there will always be accumulation, and then after accumulation, there will always be a markup, and so on. That's just not going to happen. But what I like about this diagram is that it does show that expansion follows contraction, and contraction follows expansion. So after expansion, there has to be contraction, and after contraction, there is expansion again. And this would be a lot clearer when we actually do the charts, but just introducing you to those four phases. So now for the fun part, we can finally start our technical analysis with a real life application. We can finally start charting. So here we have, as promised, the Vanguard 500. And the first step, of course, is to select our candles. So let me zoom in right here. And this is on TradingView if you would like to follow along. We just have our candles here instead of the line. As you can see, there's much more information you get from these candles of where price has been than just this. So the first step, turn on those candles. The second step, identify what trend you are in. So this is the present, or we're back testing. So things have already happened. It's called back testing, when you test a strategy in the past, and that's what we're doing right now. So even though this was like a year ago, say this is the present where my screen cuts off, and this is the trend that you are in. So first, let's contextualize ourselves. Let's look at what happened previously. Well, it looks like you are just coming out of our distribution phase, because you clearly have our markup, our bullish continuation, where you are making higher highs and higher lows. As you can see, it's just straight up, right? But then you start to pause. You start to distribute, right? As you can see, you now move sideways. You're no longer moving higher. You're in distribution. You're no longer in expansion. You're in contraction. Expansion, prices get wider. Contraction, prices get smaller. Clearly, you are contracting in this little range. But then you break out of the range and you enter markdown. So this is a real life application of what I just taught you. You have markup, then you have distribution, then you have markdown. So now that you have identified this phase as markdown, you can start to construct a market structure, or more specifically, you can start to chart market structure with what we call price levels, dynamic price levels. And price levels, the best definition I could possibly come up with, are areas of liquidity on a chart that have been historically respected by buyers and sellers in the market. And there are two types of dynamic price levels. The first being demand, which is bullish support. The second being supply, which is bearish resistance. And there is not just a demand level or a supply level. There is just a level that can be either. It's all relative to where the current stock price is. So a demand could become a supply, and a supply could become a demand. And that may sound confusing, but when we start actually doing it, I'm sure it will clear up. So, for example, right here, I have a dynamic price level marked. So as you can see here, you bounce from this level. It is an area of liquidity, so it is an area where there are many buyers and sellers that are historically respecting this level. As you can see, you're bouncing from it, but then when you break down from it, so here it's acting as demand, right? Bullish support going up, but now it's acting as resistance when you pop back up. That's why it's dynamic. It can be demand at one time, it can be supply at another time, right? Now it's supply. Now you're finding resistance. Now you double top right on this level. So you resist, you come back up, and then you resist more. So these levels here are probably the most important aspect of technical analysis to me. And you can identify these levels best by identifying the tops and the bottoms of a trend. So as you can see, what I'm doing right here is that I am identifying tops and I am identifying bottoms of this trend. So, as you can see here, you have a bottom down here, then you have a top here, okay? Then you bottom out down here, you top out again up here, then you bottom out down here, you come all the way here, then you bottom out here, and you come up again. So now the last thing that I'm going to do is I'm going to draw a trend line to indicate the tops of the markdown. And as you can clearly see, you are in a downtrend. You're in a markdown phase. And now you have all of your levels of liquidity, all of your dynamic price levels marked, all of your demand and supply. And as you can see, this is where we started. It seems kind of random. Now, well, there's a little bit of structure to it, right? So now you can answer some questions you may have had without all of this extra information that we just marked out. So for example, you may be asking yourself, well, I wonder why you topped right here. Well, it's because you came into a level of supply. You came into one of these price levels because it used to be acting as demand, right? Where you're getting nice, healthy bounces from this level. But then when you broke down and you tested it here, right? As you can see, this is a level that is being historically respected by these buyers and the sellers in the market. when you come back up into this level, that's why you're going to top. And you wouldn't have been able to see that if you did not have these levels marked. And then you come down all the way to this point, let's say, right? And you ask yourself, well, why this point? And you ask yourself, well, why exactly did we bounce? Did we have a nice bounce from this area? Well, when you have it marked, you can clearly see that back here, this used to be a level of supply. So you came up into it and then you rejected and then you came over, right? You mounted it, you got on top of it, you mounted it again, and it officially became a demand. By the way, mount just means to get on top of. So, therefore, you can clearly see why you came into this level and you bounced, because you have the tendency to do it before. Now, these levels are not always going to be respected. As you can see, they are commonly broken, right? For instance, you broke through all of these levels, and then you broke through this level to get to this level where you finally found resistance, right? So it's not always going to be perfect, but they're incredibly, incredibly useful, because look at this. Because remember, we're back testing. So this means this is all past information. This isn't the present. So if we move forward, would you look at that, right? As you can see, all these levels that we marked before any of this happened. We charted all the way up to Friday 23rd. Friday 23rd. But now we go forward, and as you can see, this historical information still has relevance in the future, or what would have been the future. So as you can see, you are finding support at these levels. Support here, but again, you're finding resistance. You come back down into support. You come up. You resist a little bit, right? You digest the move. Then you go up further. You get above this level. You come back down into it, right? You mount it. Now this is officially demand. You come back up. You still see resistance. Then you have a little counter trend. Look where you find support at one of these levels that we marked all the way back here. And you can very clearly see just by how this moves, right? Bounce, 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 that these levels are very, very, very relevant, and they were entirely based on past price tendencies. And it almost looks like they can tell the future. It's pretty awesome. So finally, to give you guys more kind of an overhead view of what we just did, and like an all-encompassing view of the chart, we went from this, which seems random and arbitrary. It just looks like you're fluctuating wherever and whenever you want. You're just going boom, 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 boom. There's no rhyme or reason to it. To then going to this, which is something that looks contained, something that looks a little bit more predictable, right? We can understand why you are bouncing at this level, where here it looks random, while here it looks like, well, you're getting above this trend line that has been, indicating the markdown phase and has been respected for all this time. You're getting above it, and you're finding support at one of these levels where you have found support before. Look here, right? You broke below it a little bit, but then you finally got back on top of it. Support again, right? And you would have never, I actually took this trade in real life. I think I made $100 or so by playing this bounce, which you could have never spotted on a chart like this. That is the power of charting market structure, and that is how you do it. You identify those levels that have been historically respected. So the easiest way to do that is to find where your trend is topping out, and then finding where your trend is bottoming, right? So as you can see, bottom here, top here, bottom here, top here, bottom here, top here. Right? That's my formula of doing it. And then you take trades according to those levels, which is a lot easier than working with nothing. And the last part and objective of this video, to give you guys a beginner understanding of technical analysis, is going to be technical indicators. What technical indicators are additions to charts that are mathematical calculations to forecast future price movements. So in simpler terms, all that a technical indicator is a tool that you can add on to your chart, which is going to give you more insight and more information into things you may have missed if you were just using the market structure strategy that we laid out in majority of this video. And kind of an analogy to give you guys, tying into the last video, is that if you look at the market structure and technical analysis as similar to the raw fundamentals of a business covered in all of the financial statements, then indicators are kind of like the metrics, like the PE ratio and whatnot, that we then add on. We first understand both subjects on the very basic level, so market structure for technicals and financial statements for the fundamentals, and then we add on with indicators for technicals and metrics and ratios for fundamentals. So there are absolutely thousands, probably tens of thousands of technical indicators, both directly provided by TradingView or whatever other charting platform you use, and also created, like literally coded by members of the financial community. And you can investigate all of these. You can try them out if you would like. But for the purpose of this video and to also keep time in mind, I'm just going to go over my top 4 indicators, my top 4 most used indicators, and the indicators that I believe have made me the most money. So back to the Vanguard 500, which is the ETF, the exchange traded fund that we did all of our market structure on and all of our charting up to this point on. We're going to introduce my first most used indicator, and an indicator that is on everybody's charts in the technical analysis field. All technicians use this, and that is going to be volume. And I personally use volume in tandem with my levels. So I use volume to either confirm or refute the validity of either respect shown to my levels or breaks that may happen to my levels. So to give you guys an example of what I mean, right here we have a break of this level. As you can clearly see, this level should be acting as resistance, as a supply level because you're below it, but you're breaking above it, causing it to become a demand level. But how do I know that that's going to hold and this is a breakout and not a fake out? Well, I like to look at my volume. So volume's down here, okay? If you look at these candles, and this is actually a candle pattern that's called 3 white soldiers, but I mean, that's a whole nother video, candlestick patterns. I look at volume to confirm the momentum. So if you look right here in your volume, the whole time you're chugging along here and you're breaking through this level, your volume is expanding, right? It's going up. It's confirming that this isn't just bears not stepping in. This is bulls going full force into this market, ripping through this level. And as you can see, the volume is going up with it. And that is how I use it. All volume is just an indicator that shows you the volume or the amount of buy and sell orders on that day or whatever time frame you're on. So I'm on the day. So each one's going to represent one day. And it's green if there's more buy orders. It's red if there's more sell orders. And that is how I use it. And I can use it also for bounces. So let me find a bounce here. So like, look at this one. This is a great example. You're coming down into this level, and as you can see, you have a huge red day, okay? Not only are you down on the day, but you have some incredible bearish sell volume. You have a lot of sell orders on this day, but look what happens the next day. There's no follow through, right? Instead, you get 3 bullish days in a row, 4 bullish days in a row, and you have sustained volume that is also above your moving average, which you can add to your volume. So you're having above average volume to the upside after a huge red day, which shows that you're not getting that follow through that you would think would happen, and instead the bulls are stepping back in. That is how I use volume. Any questions, ask in the comments. It will likely be an indicator that will come up again. So now that you understand how volume can help you know whether your price level is going to be respected, or if your price level is going to be broken through, we can move on to our next most used indicator, or my next most used indicator, which is going to be the moving average. And this is like my most used indicator. So many strategies of mine all rely on some kind of moving average, but the one I have marked on all of my charts is going to be the 200 moving average. And all that a moving average is a technical indicator that helps you round out and smooth the fluctuations of a stock, and that shows you the average price of that stock over a period of time. So in this case, I have a 200 moving average, exponential moving average. There's also a simple moving average. It's just a difference in calculation, so you don't really have to worry about it. But I use exponential moving averages, and this shows me the average price of this stock over the past 200 days. And moving averages can be used for, moving averages can be used for a lot, but I use moving averages for three things. The first is just to show trend in a very simple way. If the moving average is declining, so if it has a downward trend, that means you're in markdown, okay? So for example, this 200 moving average is confirming our markdown, which we marked earlier in this video, by sloping downwards. But look what starts to happen. You start to flatten out, and then you start to go higher, which indicates the markup that we charted earlier in this video too. So moving averages make it very easy to show you who's in control of the market, bears or the bulls, whether or not you're in markdown or markup. That's the first use for a moving average. The second use for a moving average is that it is its own level of support and resistance. So all of these levels that I taught you about, a moving average can behave as one too. So you are commonly going to get bounces on your moving average. So like look here. Right here you found resistance on it. So you shot down and then you shot up and then you found support, right? So you rejected here, you supported here, then you fell down a little bit. Right here, you bounced below it. Then you got on top of it. You got on top of it here and went higher, right? So it moving averages function almost exactly like these levels, just it's mobile. And I like to use the moving average to enter positions. So if a stock comes down and it hits its moving average, I will enter a position with hopes that it's going to bounce off of that moving average and back to the upside. That's the second thing you can do. And the third thing you can do is combine it with other moving averages, or specifically with moving averages of a shorter period or a longer period. But I started with the longer one. So I started with a 200 EMA. So I want to add on a 50 EMA to my chart. And basically what that does is that it's going to help you do those two things I just mentioned, but to an even greater level. So as you can see, the 50 also shows areas of support and resistance, like you bounce off of it here. There's an example. You bounce off of here, bounce off of it here. You find resistance from it there, right? You find resistance from it there. So it's a useful tool for that, but it also shows you crosses, which is something you really, really, really need to look for. So like, for example, right here, basically the point at which you transition from mark down to mark up. Do you notice how the longer moving average crossed below the shorter moving average? Okay, so in the downtrend, the longer was on top, the shorter was below. Now they cross. Now the longer is on the bottom, the shorter is on top. That's even greater confirmation of an uptrend than just one of them starting to slope to the upside. And this is what we actually call a golden cross. So if you have both the 200 and the 50 on your chart and they happen to cross over, that is a sign that you're going to change trend. So right here, when they cross, that's when you officially changed trend. When they crossed over here, that is officially when you change trend. Moving averages are very, very, very important, and they have made me so much money. All of my positions are pretty much entered off of a moving average. So this next indicator that we are going to be talking about here is known as the MACD, or the moving average convergence divergence. And it sounds very, very, very complicated, right? Moving average convergence divergence. A lot of big words there, but it's really quite simple. All that a MACD is it's called an oscillator. So basically it is this indicator made up of two moving averages. So it's going to be the 26, which is the slow length, and the 12, which is the fast length. And basically, these indicators are going to oscillate between extreme levels, and they are going to cross over, which gives you signs. So it's two moving averages in a histogram. This is called a histogram. And basically, all this does is that it tries to capture market highs and market lows. So it tries to show you oversold and overbought conditions. So, for example, it was giving you this indication right here when the moving averages crossed over and the histogram started to go up like this, that the stock market was oversold. And if something is oversold, that means that buyers could step back in. And that's what happened. So as you can see, you got this signal and you started to go up. For example, right here, you got this signal, you got this crossover that you were oversold, and you start to go up. That's literally how you use it. You don't have to remember all the math behind it, the 26 and the 12 moving average. You don't have to worry about any of that. All you have to worry about is understanding that a crossover means an oversold or an overbought condition. An overbought would be like right here, where you got this crossover, right? Crossover here, overbought, and then you came down. That's all you have to understand. But there is an absolutely massive flaw to the MACD, and that is that it doesn't understand trend. The MACD does not understand trend. So for example, right here, do you see how for such a long period of time you were overbought, right? You were above this histogram and you were constantly crossing over, but you see no correction in price? Well, that's because this indicator doesn't understand trend. You are in a clear markup trend. So of course you're going to be overbought because there's a lot of momentum. And the same thing for markdown. When you're in a markdown trend, when you're in a bearish trend, when prices are going down, when there are just more sellers than there are buyers in the market, you are going to be oversold for long periods of time without any correction. It's like, look at this right here. You had one crossover, two crossover, three crossover, four crossover, but you kept on going down. Well, that's because you are in a downtrend, right? So how I use this indicator is that in a downtrend, I only use it for downside signals. For an uptrend, I only use it for upside signals. So, for example, we're in a downtrend. This is to the downside, right? So I would ignore all of this because these are upside signals. This one says it's overbought, so it's a downside signals. I would enter a position. I would enter a short position, which means you bet that it goes down. And look, it pays off, right? Again, I would ignore all of this, right? Because these are all upside signals, but you're in a downtrend. So I would ignore all that. Then I would see right here that, oh, you have a sell signal and you're in a downtrend where people are selling. So I would pay attention to this one and I would use that one and look, that one actually works, right? Same thing with this one. I would ignore all of this because you're in a downtrend. Of course, you're going to be oversold. But when you start to get overbought in a downtrend, you know that you could be about to correct. But then your trend flips. So now I'm not going to pay attention to any of your overbought conditions. I'm not going to pay attention to it. I'm only going to look for upside signals. So I switch here. Here I'm only looking for downside signals. Now I'm only looking for upside signals because you're in an upside trend. So I'm going to ignore all of this, right? And as you can see, I was wise to ignore it because you just keep on going higher. But then when you get a buy signal, okay, when you get an oversold condition in an uptrend, I start paying attention. I buy the stock, and look at that. It goes up. And now you're in overbought territory. Of course you're going to be in overbought territory. So I ignore it. But then you become oversold in an uptrend, and I'm going to buy. And it works. So MACD, remember, it's a histogram, 2 moving averages that are going to cross over on your extreme levels, okay? Which indicates basically a top or a bottom, but you have to use it relative to your trend. In a downtrend, you can only pay attention to sell signals. In an uptrend, you can only pay attention to buy signals. That's just how that works. And remember, for the MACD, buy signals are when you get a crossover below 0. Sell signals are when you get a crossover above 0. So sell signals come high, buy signals come low. All right, so that's the MACD. Very useful one if you use it with trend. And the last one we're going to look at are called Bollinger Bands. Let me find them in my favorites here. There we go. So here we have Bollinger Bands. I would not use that color. That is a disgusting color. Let's change that to red and green. And this is change that to red and green and turn off the basis. I do not use the basis on my Bollinger Bands. And this is the last indicator that I use quite a bit. And it is also an oscillator. So it also is designed, is mathematically calculated to try to show you when buyers are getting ahead of themselves and when sellers are getting ahead of themselves. So basically, as you can probably already see here, it's pretty obvious, when you dip below a Bollinger Band, that's a buy signal. When you dip above a Bollinger Band, or not when you dip above a Bollinger Band, but when you go above a Bollinger Band, that is a sell signal. So this was a sell signal. This was a sell signal. This was a buy signal. This was a buy signal, right? This was a sell signal because you're above, but then you're below. This is a buy signal, okay? So this is a very useful indicator, but it also has its flaws. You can't just say, yeah, I'm going to put $5,000 into the stock because of the Bollinger Bands. You just can't. You can't just base it off of that. So what I like to do is that similar to volume, I like to use it with levels. Levels. You know those levels we spent like 30 minutes going over? All these levels? Like this is a level, this is a level, this is a level. Your supply and demand. That's what I use them with. So like right here, this example of price action where your price goes above a Bollinger Band into a supply zone is a lot more convincing to me than if you did this just in like no man's land. So look at this one. There is no level that is convincing me to buy here. There's absolutely no level. I mean, yes, you get a buy signal from your Bollinger Band because you price dip below it, but there's no level, right? There's no level. There's no reason you should be finding support here. And guess what? You started going down. But look at this one. Now you're dipping below the Bollinger Band, but you're also at one of these levels. So it's like you have 2 times the reason to believe that this is a good signal. And it was a good signal, while this one was a bad one because you're not using the Bollinger Bands with the levels, and you have to. So that is how I use Bollinger Bands. Probably the simplest indicator on here. If you dip below, it's a buy. If you go above, it's a sell. And so that officially brings us to the end of Alpha Part 2 on technical analysis. This has been an incredibly long video, my longest video yet. I really hope you guys did not watch this or even try to watch this in one sitting. I hope you broke it up into, 5-minute, 10-minute intervals. But however you watched it, thank you so much for tuning in. And little final comment, I honestly think this has been my most informative video. And if you truly learned something from this video, and if you plan to apply this knowledge, I honestly think that this could start to make you guys some money with practice. But this is a simplified version of my trading strategy in terms of technical analysis, and I hope it helped. I hope you guys learned something. Like and subscribe. Leave a comment with any questions. And I will see you guys next time on Gen Z Talks Money.